Picture this. It is a Tuesday evening in late February 2026. The sun has set over the Arabian Gulf and the towers of Dubai Marina are glowing like a circuit board against the sky. From the 42nd floor of a newly completed residence in Business Bay, you can see the Burj Khalifa lit up in its full height. The view is extraordinary. The apartment is perfect. The marble countertops are imported. The ceilings are high. The smart home system responds to your voice. The gym downstairs is world class. And nobody lives here. In fact, in this building, fewer than half the units are occupied. Down the street, in a tower that was handed over just 6 months ago, it is even quieter. The corridors echo. The parking garage sits mostly empty. The pool on the rooftop has never once been crowded. Eddie, these are not abandoned projects or unfinished shells. These are completed, ready-to-move-in premium apartments in one of the most aggressively marketed real estate markets on the planet. And they are sitting dark. This video is about what is actually happening in Dubai's luxury apartment market, why thousands of units are empty even as prices remain stratospheric, and why the story is considerably more complicated than either the cheerleaders or the catastrophists are telling you. It is also a story about timing, because the Iran conflict that sent missiles into Dubai International Airport and rattled the Fairmont Hotel on the Palm in early March of 2026 did not create the emptiness problem. It exposed it. The cracks in the glass were already there. They had been accumulating for at least 2 years. And understanding that matters, and because the question for anyone with money tied up in this market, or anyone thinking about moving there, is not just what happened. It is what was already broken before it happened. Dubai spent the better part of 2 decades building the most powerful real estate narrative in the world. The pitch was elegant and consistent. Zero income tax, zero capital gains tax, zero inheritance tax. A dollar-pegged currency that gave you stability without volatility. A golden visa program that handed you a 10-year renewable residency if you bought a property worth at least 2 million dirhams, which is roughly 550,000 United States dollars. A government that built infrastructure at a pace that made every other city in the region look lethargic. World-class airports, hotels, schools, and hospitals. An English-speaking professional ecosystem. And above all, an image of absolute, pristine, bulletproof safety. That image was the core product. Dubai did not just sell apartments. It sold the absence of fear. For the Russian oligarch after sanctions, for the Indian entrepreneur worried about political risk, for the British professional tired of gray skies and a 45% income tax rate, Dubai was the rational choice. Between 2022 and early 2025, residential prices rose by roughly 60 to 75% according to Fitch Ratings, making it one of the strongest housing cycles globally in the post-pandemic period. In 2025 alone, the emirate recorded close to 270,000 real estate transactions worth approximately 917 billion dirhams, which converts to about 250 billion United States dollars. That was the highest figure in its history. An estimated 9,800 millionaires relocated to Dubai in 2025, bringing $63 billion in wealth, more than any other country on earth according to Henley and Partners. The numbers seem to validate everything. Then you look at which lights are on. Let us start with the supply numbers because they are the foundation of everything else. According to global real estate consultancy Cushman & Wakefield, Dubai's residential prices grew 13% year-on-year in 2025, extending a growth cycle that had already run for 22 consecutive quarters. But here is what that headline masks. The pipeline coming into the market is historic in scale. Approximately 182,000 new residential units were projected for delivery between 2025 and 2026, according to industry estimates cited across multiple market reports. In Jumeirah Village Circle alone, 13,900 new units were being delivered in 2025, with an additional 11,800 planned for 2026. That single suburban community is receiving more new apartments in 2 years than many mid-sized European cities build in a decade. Across 5 concentrated zones, namely Jumeirah Village Circle and Jumeirah Village Triangle, Dubai South, Mohammed bin Rashid City, Business Bay, and Dubai Land Residence Complex, approximately 45% of all under construction stock is concentrated, and 86% of the entire pipeline is apartments. Not villas, apartments. I.e. the same product type that already makes up 80% of the existing market. In September 2025, the UBS Global Real Estate Bubble Index classified Dubai at an elevated risk level for a second consecutive year, recording the strongest risk score increase of all cities analyzed alongside Madrid. Fade Iqbal, Chief Investment Officer for the Middle East at UBS Global Wealth Management, articulated the specific concern clearly. A high proportion of likely speculative off-plan transactions combined with an elevated new supply could trigger a price correction. And crucially, UBS noted that by 2029, Dubai's housing stock is likely to have grown by a third. One-third more apartments in a city that already has more apartments than it is renting out. Compared to comparable markets, the picture is striking. In Singapore, where rental growth has consistently outpaced price growth, the rental market is tight because supply is tightly managed. In London, residential vacancy rates in prime neighborhoods hover in the low single digits. In Dubai's Jumeirah Village Circle in Dubailand, landlords were already offering discounts and added amenities as early as the third quarter of 2025 to attract tenants. According to market analysis from the Dubai real estate data platform Meeyar, that is not a market in equilibrium. That is a market where sellers and landlords are already negotiating from a position of oversupply in specific zones, even while the headline narrative talks about a boom. Here is where the story gets urgent, and where you cannot analyze Dubai's empty apartments honestly without talking about what happened in the first week of March 2026. Iran launched more than 1,000 drones and missiles toward targets in the United Arab Emirates, damaging infrastructure including portions of Dubai International Airport and the Fairmont Hotel on the Palm Jumeirah, along with residential and tourist areas. Explosions were also reported near Zayed International Airport in Abu Dhabi. The airspace was shut down. Major airlines rerouted. The Dubai Financial Market and Abu Dhabi Securities Exchange halted trading. Shares of Emaar Properties and Alder Properties, the two most important listed developers in the country, each fell approximately 5% in a single session. Bond markets for UAE developers effectively closed to new borrowing. The credit rating agency Fitch Ratings said publicly that the effect on real estate values would depend on the conflict's scope and duration, and in that expatriate departures could put pressure on Dubai's housing market. Fitch had already, in the spring of 2025, predicted that new supply pressures could push prices down by as much as 15% by late 2025 and into 2026. The conflict arrived precisely as that supply wave was gathering pace. Ryan Lehman, co-founder and chief executive officer of Neovision Wealth Management in Abu Dhabi, said it plainly in a statement to Reuters. Real estate investment typically relies on stability, visibility, and sustained investor confidence, all of which tend to weaken during prolonged geopolitical uncertainty. Hasnan Malik, who leads emerging markets equity and geopolitics strategy at Dubai-based Telemer, told the financial network CNBC that Dubai's safe haven narrative had been called into question in one specific dimension, which he described precisely as the lifestyle driver of pristine security. That is the exact attribute that was not replaceable overnight. You can rebuild a terminal. You cannot rebuild the feeling that the missiles will never reach here. And that feeling was the product. Dubai sold certainty. That was the real product. A Swiss bank of real estate. And the missile that hit the Fairmont was not just a piece of ordnance. It was a question mark inserted into the prospectus. The conflict did not affect everyone with skin in this market equally. That is something the broad analysis consistently misses. 3 layers of exposure exist here, and they behave in completely different ways. At the top, the ultra-high net worth investors, the hedge fund managers in the Dubai International Financial Center, the family offices that moved capital here after 2022, those holding $20 million or more in diversified assets, for them, the immediate shock is noise. Hasnan Malik of Telemer confirmed as much, noting that the tax regime, the regulatory environment, and the banking stability that draw this cohort are all still intact. Dominic Volek, the group head of private clients at Henley & Partners, made the observation that internationally mobile families typically diversify residence and citizenship across multiple regions, so they already have optionality. For them, Dubai is one node in a global portfolio. The missiles do not change the tax treatment of their assets. In the middle, the professional expat class, the financial sector workers, the tech executives, the consultants, the people paying annual rents of 115,000 dirhams for a one-bedroom in downtown Dubai or 100,000 dirhams in Dubai Marina, which converts to roughly 27,000 and 23,000 United States dollars per year respectively, this is where the pressure is most visible and most human. These are the people whose lease renewals are coming up. These are the people who had made a 5-year life plan around the city. Some companies relocated operations after the attacks. Some professionals began quietly exploring Lisbon, Singapore, or Abu Dhabi as alternatives. The psychological calculus changed. The Fairmont was not just a hotel, it was a symbol. It was where people celebrated. When it was hit, something shifted in the expat mind that has nothing to do with economics. And at the bottom, but largely invisible in the market analysis, are the construction workers, the hospitality staff, the taxi drivers, the cleaners, the delivery workers, the people who make the luxury machine function. The workers who built those towers sitting empty in Business Bay earn on average between 1,000 and 2,000 dirhams per month in base wages, which is roughly 270 to 550 United States dollars, sending a portion home to South Asia or East Africa. A slowdown in construction pipelines hits them first and hardest. They have no golden visa. They have no diversified portfolio. If the construction sector pauses, they lose income with no safety net. They are the last mentioned and the first affected. The dream was never a single dream. It was 3 or 4 completely different arrangements stacked under the same skyline. Now here is the part that the official tourism boards and the developer marketing departments genuinely do not want you to focus on, because it predates the missiles by at least 2 years. The empty luxury apartments are not a product of the conflict. They are a product of how Dubai's real estate market was structured, sold, and absorbed, or more precisely, not absorbed. The structural vulnerability number 1 is the speculative off-plan architecture. Over 70% of all residential transactions in early 2025 were off-plan, meaning buyers were purchasing units that did not yet exist on payment plans, often with no intention of living in them. The business model was appreciation and flip, not occupation and rent. When Emaar or Damac Properties or Bingati launch a project and sell out in 48 hours, the buyers are largely investors from India, Russia, China, the United Kingdom, Ukraine, and Western Europe, buying a dirhams-denominated asset as a hedge, a golden visa vehicle, or a speculative play on continued price appreciation. Many of those investors do not rent out their units. They hold them vacant, expecting to sell at a profit before the holding costs become painful. UBS specifically named this dynamic in the 2025 edition of its Global Real Estate Bubble Index, noting that building permits suggest new construction could reach levels last seen in 2017. Historically always a major risk in Dubai. Matthias Holze, the lead author of the UBS report, stated directly that construction picking up is always a risk in Dubai, and that prices being high enough to incentivize speculation is itself a risk factor. The structural vulnerability number 2 is the product mismatch. 66% of upcoming units consist of studios and one-bedroom apartments. The expat population that drives rental demand is aging in the market. More families are putting children in private schools, with enrollment up 6% in 2025, according to Cushman and Wakefield. Families need 2- and 3-bedroom units. They are not looking at the supply that is flooding in. The structural vulnerability number 3 is the luxury overvaluation. The UBS Global Real Estate Bubble Index specifically stated that the luxury segment was increasingly overvalued in its 2024 assessment, and then escalated Dubai to elevated risk territory in 2025. David von Rosen, the founder of luxury villa developer 25 Degrees, said publicly in comments reported by the Arabian Gulf Business Intelligence publication, there is an oversupply to some extent in the luxury apartment part of the market, combined with a lot of people buying off-plan, not wanting to live in the apartment but wanting to flip it as an investment. That is an insider voice. That is someone inside the Dubai luxury development industry saying what the brochures do not say. And when an insider from within the market establishment admits the problem in plain language, That data point is worth 10 external analyst reports because it cannot be dismissed as external bias. So what happens now? Let us be precise about this because imprecision is what sells panic and what sells complacency in equal measure, and neither serves you. Dubai has recovered from genuine crises before. During the global financial crisis of 2008, residential prices fell by 50 to 60% according to analysis cited by the research firm Anarock, and the market took 6 to 7 years to fully recover. During the pandemic in 2020, Dubai's population contracted. The number of millionaires in the city fell. And then, 2 years later, the city posted record transaction numbers. That historical resilience is documented, real, and should not be dismissed. The recovery mechanisms exist. The tax structure remains. The golden visa program remains. The dollar peg remains. The infrastructure is genuinely world-class. What does not recover quickly, and this is the distinction that matters, is the specific product that is now oversupplied. 31,000 new units in Jumeirah Village Circle over 2 years. 86% of the pipeline in apartments. Off-plan flippers who cannot find buyers at acquisition price once sentiment shifts. The luxury apartments sitting dark in Business Bay and Mohammed bin Rashid City are not going to be filled by the conflict ending. They were not filled before the conflict, and the supply pressures are structural, meaning they will persist regardless of what happens geopolitically in the Gulf in the next 6 months. What the conflict did was accelerate a recalibration that Fitch, UBS, and several independent market analysts had already identified as likely. It turned a manageable correction into a visible one. The operational recovery, airspace, hotel bookings, short-term rental occupancy, those metrics will improve faster. The confidence recovery, the feeling that someone in Edinburgh or Mumbai or Beijing will wire money into a Dubai off-plan investment without a second thought, that takes much longer. And the structural recovery, the absorption of the unit pipeline, the recalibration of the off-plan speculative model, the realignment of product type with real demographic demand, that is not a month's project. That is a year's project if the political will for reform exists, which it may not given how much government revenue is tied to land sales and developer fees. Knight Frank, in research produced before the conflict, projected 331,000 new homes delivered in Dubai between 2026 and 2030. That pipeline does not disappear because of a geopolitical event. It compounds the existing mismatch. And S&P Global Ratings, in reporting from the National in March 2026, noted that smaller and less established developers may face the most pressure, which matters because a significant portion of the off-plan boom was driven by developers whose financial resilience in a downturn has never been tested. If you own an apartment in one of Dubai's more established, prime, well-located communities, your situation is different from someone who bought off-plan in an outer zone from a developer no one had heard of 18 months ago. The market is not one market. It is dozens of micro-markets behaving in different ways under the same brand. Has any of this changed your thinking about Dubai? Whether you are there now, thinking about going, or have money tied up in the market? What does the calculus look like from where you are sitting? The comments below this video exist precisely for people who have been inside this story rather than just watching it from the outside. And if this kind of ground-level, data-driven analysis of the cities and markets that the world is watching most closely is what you come here for, then you already know what to do next.